They finally confirmed it. For years, silver investors were told this move was impossible, unrealistic, exaggerated, or pure hype. But now, the conversation has changed. Major analysts, institutions, and market signals are openly pointing toward a potential $309 price target for silver. In this video, I'll explain what was confirmed, why silver is entering a critical phase, and whether this target is realistic or not. Make sure you watch till the end, because the last part is the most important. When we say silver is confirmed toward higher levels, it does not mean someone flipped a switch overnight. It means the narrative has fundamentally changed. For years, silver was systematically ignored despite inflation running hot, central banks printing unprecedented amounts of money, and demand rising across multiple sectors. Today, institutions are no longer denying the structural problems in the silver market. Supply is getting tighter, inventories are falling at major exchanges, and demand keeps rising from both industrial and investment sources. This is exactly how major commodity moves begin. They start quietly, under the radar, while most people are distracted by other assets. Then, suddenly, the price catches up to reality in a way that shocks even experienced traders. What makes this confirmation different from past speculation is the credibility of voices now entering the conversation. We're not just talking about retail investors on social media or small newsletter writers predicting astronomical prices. We're seeing institutional research reports, major commodity analysts, and even some banking institutions acknowledging that silver's current price does not reflect its underlying value or the supply constraints facing the market. When the narrative shifts from dismissal to consideration, that's when serious money starts paying attention, and serious money moves markets. Silver is not just a precious metal, it's also a critical industrial metal, and that dual nature is what makes it fundamentally different from gold. Electric vehicles require significant amounts of silver for their electrical systems and battery technology. Solar panels are one of the largest and fastest growing sources of silver demand, with each panel containing approximately 20 grams of silver that cannot be easily substituted. Electronics, from smartphones to computers to military equipment, all depend on silver's unique conductive properties. Green energy infrastructure, which governments around the world are heavily investing in, is essentially a silver consumption machine. And here's the critical part. There are no real substitutes that can match silver's performance at scale. At the same time, mining supply has failed to keep up with this surging demand. Unlike gold, where production can sometimes be ramped up relatively quickly, silver production faces unique challenges. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. This means silver supply is largely dependent on the economics of those base metals, not silver itself. Even when silver prices rise, if copper or zinc prices are weak, many mines won't increase production. Primary silver mines do exist, but they represent a minority of global supply, and developing new mines takes years and massive capital investment. This creates a supply-demand imbalance that's been building for years, and historically, when that happens in commodity markets, prices don't rise slowly and steadily. They explode. We've already seen warning signs of this imbalance. Silver inventories at major exchanges like the COMEX have been declining. Physical premiums, the amount buyers pay above spot price for actual silver coins and bars, have remained elevated even during price corrections. This tells us that real physical demand is strong, even when paper markets suggest otherwise. Industrial users are reportedly securing long-term supply contracts, something they typically do when they expect tightness or price increases ahead. These are not the actions of a market with abundant supply and weak demand. These are the actions of a market preparing for scarcity. So where does the $309 number actually come from? Is it just a random figure designed to generate clicks and excitement, or is there actual logic behind it? Let's break down the reasoning. First, look at history. During previous bull cycles in precious metals, silver massively outperformed gold on a percentage basis. In the 1980s bull market, silver went from around $5 to $50, a 10 times increase. During the 2011 rally, silver went from single digits to nearly $50 again. Gold made impressive moves during those periods, but silver's percentage gains were far larger. This pattern of silver outperforming gold during bull markets is well documented and has to do with silver's smaller market size and dual demand nature. Second, consider the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 50 to 1 and 60 to 1. During times of economic stress or precious metals bear markets, the ratio can spike to 80 or even 100 to 1, meaning silver becomes extremely cheap relative to gold. We've seen those extreme levels in recent years. Now, if gold holds at elevated levels, let's say $2,000 or higher, and silver simply reverts to a more normal historical ratio of 50 to 1, that would put silver at $40 or more. But that's conservative. If we enter a real precious metals bull market where both metals are rising and the ratio compresses further toward historical lows of 15 to 1 or 20 to 1, which has happened before, suddenly triple-digit silver becomes not just possible, but mathematically logical. Finally, look at the technical charts. Silver has been in a long-term consolidation pattern for over a decade. When you zoom out and look at the monthly and yearly charts, you can see that silver has been building a massive base. Whenever an asset consolidates for that long while fundamentals improve, the next leg higher tends to be aggressive and fast. Breakouts from decade-long consolidation patterns don't result in small, gradual price increases. They result in explosive moves that catch most investors off guard. This is why analysts who understand technical analysis are no longer laughing at these targets. They're preparing for them. They're watching key resistance levels and accumulation patterns that suggest something significant is building. Now let's be completely honest and realistic here. Silver is volatile. It always has been, and it always will be. The same characteristics that allow silver to make explosive moves to the upside also make it capable of sharp, painful corrections. This is not going to be a straight line to $309. And anyone expecting that is setting themselves up for disappointment and poor decision-making. Corrections will happen. There will be periods where it feels like silver is going nowhere, or even falling when you think it should be rising. Timing matters enormously in volatile markets, and trying to time the exact bottom or top is nearly impossible even for professionals. But here's what separates short-term noise from long-term signal: fundamentals. Long-term moves in any market are built on fundamental supply and demand dynamics, not on daily price action or short-term sentiment. And right now, silver's fundamentals are stronger than they've been in decades. We have structural supply constraints, rising industrial demand from irreversible trends like electrification and renewable energy, potential investment demand if inflation concerns persist, or if faith in fiat currencies weakens, and a market that remains relatively small and overlooked compared to other assets. Smart money understands this. That's why you're seeing changes in positioning. That's why institutional interest is quietly growing. That's why the narrative has shifted from dismissal to consideration. The biggest risk is not volatility. Volatility is normal and expected. The biggest risk is being completely out of position when the move happens. Silver moves fast. When it breaks out, it doesn't send you an invitation to participate. It doesn't wait for you to finish researching or wait for your next paycheck. Markets reward those who are positioned before the crowd realizes what's happening. That doesn't mean going all in recklessly or betting money you can't afford to lose. It means being thoughtfully allocated based on your own financial situation and risk tolerance. It means understanding that in your portfolio, some allocation to real assets like silver might make sense as a hedge against currency debasement, inflation, or systemic financial risks. Another consideration is how you hold silver. Paper silver, like futures contracts or certain ETFs, can be useful for trading and speculation, but they come with counterparty risk and don't give you the same protection as physical metal. Physical silver, whether coins or bars, gives you direct ownership with no counterparty risk, but it's less liquid and comes with storage considerations. Mining stocks offer leverage to silver prices and can outperform the metal itself during bull markets, but they also come with company-specific risks, management issues, and operational challenges. There's no perfect answer. The best approach depends on your goals, timeline, and risk appetite. But the point is to be aware of these differences and structure your position accordingly. So the real question facing anyone watching this video is not whether silver can reach higher prices. The fundamentals, the history, and the technical setup all suggest that significant upside is possible, even likely over time. The real question is whether you're early, late, or watching from the sidelines. Are you positioned before the move, or are you waiting for confirmation that will only come after prices have already risen substantially? Are you prepared for volatility, or will the first correction shake you out right before the next leg up? These are the questions that will determine your results. If you found this breakdown helpful and want to stay informed as this silver story continues to develop, make sure you like this video, subscribe to the channel, and turn on notifications so you don't miss future updates. The silver market is entering a critical phase, and the next few years could be unlike anything we've seen in decades. And if you came here from the short video, thank you. This is where the full story lives, where we go beyond headlines and hype to understand what's really happening in these markets. Stay informed, stay rational, and position yourself accordingly.